Before we get into gains and losses, I just really quickly want to go through how debits and credits work. And all debit means is left, and all credit means is right. And when we're talking about left and right, we're talking about a T account. This is a T account. And the reason they call it a T account is because it looks like a T. So just very briefly, assets, and we're going to assume we're talking about a corporation. Assets, expenses, and dividends all increase with a debit and decrease with a credit. Liabilities, revenues, and stockholders' equity all increase with a credit and decrease with a debit. Debit and credit have no value attached to them. The word itself has no meaning. It doesn't mean good or bad. It simply means debit left, credit right. So, before we had this gain or loss situation, we purchased equipment. Equipment is an asset. So we increased our asset account, so we debited it. Accumulated depreciation is a contra asset account. It reduces our assets. So the way we increased accumulated depreciation was at the credit. So before we sold this equipment, we had debited equipment for $40,000 and credited accumulated depreciation for $30,000. And now we're going to go through and look at, do we have a gain or do we have a loss? And I'm just going to show you how we would record the entries. So, for the first situation, we have B company sold equipment that originally cost $40,000 for $20,000. At that point in time, accumulated depreciation on the equipment was $30,000, and we want to know what's the gain or loss. Okay, you start off with the cash you received. We received $20,000. And then you're going to subtract the book value of that equipment. To determine the book value, you take your cost and you subtract your accumulated depreciation. So $40,000 minus $30,000 would equal $10,000. $20,000 minus $10,000 is $10,000. If you end up with a positive number here, you have a gain. So here we have a gain on the sale of $10,000. Okay, now we're selling the equipment, right? So we need to get rid of it. So to get equipment to zero, we're going to credit equipment for $40,000. And to get accumulated depreciation to zero, we're going to debit accumulated depreciation for $30,000. So the way we would record this is we would debit cash $20,000, debit accumulated depreciation $30,000, right? We just did that. Credit, which is what we did here, credit equipment for $40,000, and then credit our gain on the sale for $10,000. Something I just want to mention to you about when we're recording the entry, debit is pretty much flush left, and when you're doing your credits, you're indenting slightly. You'll also notice that your debits and your credits are going to add up to be the same number. So we have cash and accumulated depreciation is $50,000. Equipment and gain on sale is $50,000. They're going to be equal. Okay, the next thing we have, if you look, it says, what's the gain or loss if $10,000 were received in the above example? Well, the only thing that's changing here is the cash received. So we're going to change cash to 10. Our book value is still 10. So right now we end up with 0, right? So we still have to debit accumulated depreciation and credit equipment, but we are now going to debit cash for 10, and this gain no longer applies. Okay? And the last situation, what's the gain or loss if $5,000 is received? So in this case, we've got 5. We're still going to debit accumulated depreciation for that 30. We still need to get it off the books. And credit equipment for 40,000. Need to get that off the books. That doesn't change. Our cash is going to change though. Cash is 5,000. Now we have a loss. We debit a loss. So we have a loss of 5,000. 5,000 minus 10,000 is a negative 5,000. If it's negative, it's a loss. So we're going to go ahead and debit our loss. Okay? So again, we're looking at assets that we debit and credit. Losses, increase in losses, we debit, and we did previously with our gain, an increase in a gain is credited. Okay, so now the last thing we're going to do, if you go to the very last page, we're going to do an assignment example. So this is exactly the same type of assignment that you're doing, same kind of questions, 4 questions. I'm going to tell you which tables you need to go to in order to solve each question. So the first question, suppose you invest $1,000 in an account bearing interest at the rate of 10% per year. What will be the future value of your investment in 4 years? We are going, for this information, we have to go to table 1. We're putting in one sum of money. We want to know the future value. So in our case, in this example, the number of periods is 4 years, and the interest rate is 10%. So if you were to look at table 1, 4 years, 10%, you will get a figure. The discount rate we're going to use is 1.464. So we take that $1,000, multiply it by 1.464, and we end up with $1,464. Second question, someone will give you $5,000 in 2 years. If you had the money today, you can invest it at 8% annual interest. What's the present value of that future gift? That's table 3. We're talking about one sum of money and we want the present value. So we're going to table 3, and we're looking at 2 years, 8%. So now if we take 5,000 multiplied by the discount rate, if you look at table 3 at 2 years, 8%, you'll get a discount rate of 0.857. You will end up with $4,285. Number 3, in 2 years you will need $5,000 for an investment. How much money would you need to invest each year in an account bearing interest at the rate of 4% per year in order to accumulate the $5,000 purchase? Here we are going to table 2. We're going to do something slightly different. We're going to take the dollar amount, $5,000, and we're going to divide it. So we're going to take that $5,000 and we're going to divide it by the discount rate. And again, this is 2 years at 4%. So if you go to table 2 and you look at 2 years, 4%, you will see a discount rate of 2.040. Once you divide it out, that's 2,451. Last question. You estimate you'll need $10,000 a year over the next 2 years. How much do you need in your account now in order to withdraw the required amount each year at an interest rate of 4%? So here we're going to table 4. It's the present value of an annuity. We have 2 years, 4%. So we're going to take our $10,000, multiply it by the discount rate we're going to get, if we look at 2 years, 4% in table 4, which was 1.886, and we get 18,860. You're going to do the same thing. You're going to go to the same tables when you do your homework. Table 1 for question 1, table 3 for question 2, table 2 for question 3, table 4 for question 4. Remember, for question 3, you divide it. If you want to send it to me before Sunday, I can go ahead and mark it for you and send it back. If not, just go ahead and send me assignments Sunday. If you have questions, feel free to contact me. Have a great week, everyone.